Friday, October 16th, 2020, Maneco 64, home of alternative economics and contrarian views. So the political season is getting really interesting. A lot of distractions out there. Hunter Biden, President Trump talking about vaccines, that he's not going to mandate it. And I have to admit, it's tempting to cover all these subjects, but I think they're all distractions. The political arena, in my opinion, is just a big distraction to keep people divided. And unfortunately, if that's what you want to listen to, it's not going to be here. So today I'm going to focus on the fundamentals for the US dollar. I think the fundamentals for the US dollar and co. And what do I mean by co? Well, I mean all the other fiat currencies that derived from the dollar once the Bretton Woods Agreement came about in 1944. Yes, Nixon kind of wrecked that agreement, but all fiat currencies nowadays are derived from the dollar to some extent, mainly because the dollar is the major reserve currency for the world, and every country has to have dollar reserves to function. So we need to get out of the paradigm of dollars versus euro, dollar versus yen. We need to look at the dollar and the other currencies as fiat currencies and their fundamentals versus real money, i.e. Gold. And in the last few days, we've seen the IMF come out and say that we can have our cake and eat it in the West. And by that, I mean, they're saying, don't worry about austerity. Don't worry about your finances. Keep spending. Keep putting yourself into debt because interest rates are really low. It's going to kickstart the economy and everything will be fine. So the IMF is pushing countries like the US, countries like the UK, the Eurozone to keep borrowing. That's not going to end. The IMF, of course, works closely with central banks. And I think they're coming with more and more negative interest rates. And that's not going to help. How good has it been for Japan and the Eurozone to have negative interest rates? It hasn't been any good, and it's not going to be any good for the UK nor the US. And I think negative interest rates could come to the US. And also negative yields. There's a difference, of course. And even the IMF, I think the IMF director said yesterday that the US will definitely join in after the election. I wanted to show you a couple of charts from Tavi Costa at Crest Capital. I interviewed him a few months ago. I need to interview him again. He's a really good analyst, and he's come up with these two charts here. US fiscal deficit as percentage of GDP. So there you go. And it's not going to get better. We saw the weekly jobless claims come out higher than expected yesterday. It's creeping up towards 1 million. So things are not improving. I don't think they're going to get better anytime soon. But as you can see here, yeah, deficit running at 15% of GDP. Even prior to the crisis, you can see that the deficit was running at 5% of GDP, which was weird because it was the greatest economy ever, right? So the United States government or Treasury did not save for a rainy day, even in the best of economies. So can you imagine what is going to continue to happen with this deficit? And then the other interesting chart that Tavi Costa of Crest Capital provided is the global negative yielding bonds. So back in 2019, that reached, I think, almost 17 trillion. Yes, with a T. There were 17 trillion bonds out there with negative yields. So that means if you buy a bond, you're actually going to pay the borrower to hold on to that bond. You're not even getting a return. It's crazy. And he's actually done a chart here. The technical analysis of how this is looking, it looks like we're going back towards a world where negative yields are going to be the norm. And I think the technicals here correspond with the fundamentals, with what the IMF is saying, with what I think is going to happen during this second wave. It's going to be a second wave, not only of the crisis, but it's going to be a second wave of fiscal and monetary stimulus. The fiscal, of course, is going to come in the way of more and more deficit and debt financing by the governments. The monetary will come, of course, with the increase in the balance sheets of the banks, central banks. That means more QE. The Fed's balance sheet has stabilized for the last few months around 7 trillion, but you can bet that's going to start picking up again towards 10 trillion. So with those fundamentals, the dollar and the other fiat currencies, they will only go down in value. And in my opinion, the most reliable measure of value, not only monetary, but value in general versus real things for the last few thousand years, has been gold and silver to some extent. And that's why they're going to continue to lose value versus those measures. And why is that? Well, it's the simple law of supply and demand. In our current fiat currency system, the only way to generate fiat currency is through debt. So if you're going to increase the debt to increase the fiat currency, those fiat currencies are going to lose relative value versus things that are not that easy to produce. The more you produce of something out of thin air, relative to things that take effort to produce, that you can't conjure up out of thin air, the more those things are going to be worth less. And that's why we're going to have currency debasement. And that's why they're going to continue, the powers that be, to inflate to infinity until they can't, until it all implodes and collapses. It could be a deflationary collapse, but I'm leaning more and more towards a hyperinflationary collapse, to the crack up boom that von Mises talked about. And why is that? Well, because it doesn't look like the monetary and political powers that be want to stop the inflation. And I think it's too late, and people are going to lose confidence in the fiat currencies, the dollar, and all the other ones. So with that, let's look at where the markets are this morning. It's 8:45 a.m. London. The stock markets yesterday were not doing well. They rebounded towards the end of the day. Let's see where they are today. Well, gold did well yesterday, so did silver. We got back up above 1900. Right now, gold is at 1908.50, up less than $1. The range has been 1902.50 to 1911. Silver's up 4 cents at 24.32. Range has been 24.10 to 24.43. So I think right now 24.50 is a key resistance for silver. Gold, 1920 is the key resistance. The Dow future is down 20 points, 28,475. S&P is down just over a point. NASDAQ 100 futures down 7 points. So the markets are fairly quiet right now. So the fiat currencies versus the dollar, sterling is unchanged, 129.15. The euro is at 117.12. That's up slightly versus the dollar. Dollar is down 0.1% against the yen, 105.29. The price of crude oil is down 0.5%, still stuck around that 41 level, just below 41. And today I'm going to look at the bond markets as usual, but I'm going to show you the German, French, and Italian yields so you can have an idea of the negative yields and how bad it is. So the 10-year yield is at 0.73, so we've gone up slightly from yesterday. I think we were at 0.71 yesterday morning, so not much change there. But as for the negative yields, you just have to look at the German government bonds yield list here, and you've got negative yields all the way up to 30 years, you're getting minus 0.2% negative yields in Germany. The other interesting thing, you look at the little chart here at the top, the current yield curve, as you can see, is the blue line, the dark blue line. You've got a month ago, yields were higher, and a year ago, they were higher. So the tendency here is for it to keep going lower, as you can see. So that's why the fundamentals are not looking great for the fiat currencies, because it looks like we're going to get even more negative yielding bonds, and the trend is showing that. So let's look at France. France, you get a negative yield up to 15 years. You get minus 0.18. And the same thing is happening to the trend. We're starting to see yields drop compared to a month and a year before. And Italy, which has been known to be a profligate government, they used to pay the highest yields many years ago. But even Italy, you're getting a negative yield up to 4 years, and the same trend is starting to happen in Italy. Yields have been falling over the last year. So there you go. Things are not looking great for the fiat currencies, dollar included. As I said, don't try to hedge fiat currency exposure by getting into another fiat currency. I personally think that's not the way to go about it. I would go about it by having precious metals, physical, of course. So if you enjoyed this video, make sure you hit the like button. Please share it far and wide. Think about subscribing to the channel if you haven't yet. Make sure you also hit that little notification bell to be notified of all my new videos. And you can also follow me on Twitter, Facebook, and all these other platforms below here. I wish you all a great day. Take care. Bye.